Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the DFK Australia New Zealand Lunchtime Masterclass, which is all about maximising your super fund. Thank you for joining us in your break, and we do hope that this presentation fills you with the information and the motivation that you need to move forward to maximise your own super and create that life and retirement that you're imagining probably right now. So your hosts today are Melissa Healy from DFK Everalls in Canberra and Julia Bull from DFK Benjamin King Money in Melbourne, who will be sharing their expertise and insights with you. But before we get started, just a little bit of housekeeping. You may not have been aware of who DFKANZ was before you registered to join us on this masterclass. Now, we are an association of accountancy firms across Australia and New Zealand, but we also have connections right around the world. There's 240 member firms in total for DFK around the world. There's 14 of those firms in Australia and New Zealand, and we're represented across 92 countries. Now, in addition to sharing lots of insight about how to maximize your superannuation, we can also provide you with the different sorts of services you can see here on the slide. Business structure and setup, valuations, diligence, the good old accounting, tax and compliance assistance, but also strategic planning workshops. We're very much about helping you grow your business from the inside out. Now, when we're talking all things superannuation, it is essential for us to share with you the disclaimer that is on the screen at the moment and is also as a handout, which you'll be able to see in your GoToWebinar control panel on the right-hand side of your screen. We need to let you know that the presentation is current as at today. The material in the presentation is only a summary and you can't consider it as a comprehensive statement on any matter. You can't rely upon the general examples and overview that we are giving. The examples are for illustration only, so please, yes, grab the copy of the disclaimer if you want to refer to it. But the good news is what we are covering is employer contributions, personal contributions, and other contributions, the way that you can maximise the funds that are inside your superannuation fund. You'll also receive a recording of this presentation and a copy of the slide deck, because we will be going into great detail on lots of things, and you may not be sitting there with a pen and paper, but nevertheless, we will be giving you this copy so that you can refer back to it. Now, it's useful for us to do a couple of quick polls so that Julia and Melissa can understand who we have on the line, where you're at in your superannuation journey, so that the information and the examples that we share can be much more tailored to the audience that we have today. So to participate in the poll, you'll just click on them as they come up on the screen. There's just two questions that we have. And the first one is coming up now, to understand which age bracket that you are in. So if you can just do a quick click for us there. Fantastic. We've got quite a few votes. I'll just wait another few seconds. Okay, we have a really good split. I'll just share the results on the screen. So we have 29% of our callers are under 50, 38% at 50 to 60, and 33% over 60. So a good split there, which will help us with those examples. Okay, the second poll is just to understand where you're at in terms of your contributions. So how much that you have currently put aside in super, because this will influence the type of strategies that are most relevant for you. Lay it over that age group as well. And just watching the votes come in. Let's wait a few more seconds and then we will share. Fantastic. Okay, we're almost completely voted, so here are the results. Almost half have got less than the 250k, a small amount just under the 500, and then an equal split around under 1.4 and over 1.4. And our presenters today will explain why those particular marks are so important. So thank you for that. Only other little bits of housekeeping. There will be a Q&A at the end of the presentation, and in the dashboard you'll be able to raise your hand by clicking on a button so I can unmute you and you can ask the question that you'd like to ask. But during the presentation, if anything comes up, you'll see a chat box, which is also in the control panel. You can type your questions in there. I'll be monitoring that box whilst Melissa and Julia are presenting, and I'll bring up any of the questions that you have that are relevant for the girls at that particular point. point. So apart from that, relax, sit back or sit forward with curious ears to find out how you can maximise your super. I'll now pass you over to Melissa to get the ball rolling.
Thanks very much, Angela. Welcome, everybody. Thank you so much for joining us. We are going to be talking to you today about 10 different ways you can boost your superannuation by making extra contributions into your fund. Before I dive into that, just a friendly reminder that obviously you can also boost your superannuation by making sure that you pick a good superannuation fund that has value for money fees. Make sure that your super money is invested correctly based on your personal risk profile. So that's where a financial planner comes in very handy to talk to you about what kind of investments are appropriate for you and your goals. You know, make sure you can sleep at night knowing that your super money's under control and working hard for you. And remember to review your superannuation regularly. So when those annual statements turn up in the mail, do have a closer look at them so that you can see what's going on. Superannuation is obviously a very tax effective environment for you to save in, and we'll be highlighting more specific issues about that as we go through these different kinds of contributions. So as Angela mentioned, we have some employer contributions, we have some personal contributions, and there's some other ones. For example, the government might put in some extra money, or perhaps you can use money from the sale of your house or from the sale of your small business. So there's a variety of sources of money that can help you boost your superannuation balances. So we're going to start off today by looking at your employer contributions. The trick here to boosting your superannuation is to make sure that your boss is actually putting super contributions into your fund. So again, this is another reason why you should be reviewing your super fund regularly to make sure that you are seeing those monthly or at least quarterly contributions going into your account. The boss has to pay 9.5% of your gross wages as superannuation. It's calculated on your ordinary time earnings, i.e. not including overtime unless you ordinarily work overtime, in which case they have to pay it on that as well. There is a minimum in terms of you have to earn at least $450 in a particular month gross for them to have to pay the 9.5% on it. And for the record, there is a maximum SGC amount that employers have to pay. So in other words, once you're earning more than $216,000, the max 9.5% of that is $20,500. So you need to check your employment contracts if you're lucky enough to earn more than that, to make sure that the boss is going to put in 9.5% of your gross wage, even if technically per the law the most he has to put in is only the $20,500. So just watch out for that. With employer contributions, with these 9.5% super guarantee contributions, there is no age or work test. So if you are working, subject to those minimums and maximums, the boss does have to put the 9.5% in. The next type of employer contributions are salary sacrifice ones, and these are where you can voluntarily top up, get the boss to top up the superannuation contributions that they're making on your behalf by saying to them, well, how about you, for example, reduce my gross pay by $5,000 a year and put $5,000 more into superannuation for me. This is really tax effective because the money going into the super fund is only taxed at 15%, whether it's that 9.5% super guarantee contributions or salary sacrifice contributions. That 15% is probably a lot better than your personal marginal tax rate, which could be 19%, 32%, or even 45%. So 15% is cheaper than that. And therefore, if you were going to be saving that money anyway, then contributing it into your super fund and only paying 15% of it so that the other 85% is working for you is quite a tax effective way of doing it. The thing to watch out for is that the maximum amount of super contributions per person per year that you can claim, well, that you personally can claim as a tax deduction, is the 25,000. The boss is allowed to put in more than that, but the first 25 grand will be taxed at 15% in the super fund, and the tax office will send you an excess contributions notice if you go over the 25 grand. So it's therefore not really tax effective to bother trying to salary sacrifice more than the 25 grand a year in it. Boss doesn't care, but it will bite you in terms of that excess contributions notice at the end. One last note there is just that, particularly if you're a business person and your business is paying your insurance premiums, which are done through a superannuation fund. So quite often you'll have an MLC or an AMP or whatever it is that your insurance is through, but it's done via a so-called super policy. So the company can pay them as super contributions for you, but you've got another super fund on the side, maybe a self-managed or maybe another retail kind of fund. You've got to remember to add all those contributions together when you're calculating that 25 grand. So just be a little bit careful on that front. So two types of employer contributions that you can do. Then we look at personal contributions. Now, if you're self-employed, and for the last few years, even if you are an employee, you are allowed to make personal tax deductible contributions into your fund. So there's no rules anymore about employees not being able to put money into super. So for example, there are a lot of companies out there that for one reason or another don't want to muck around with salary sacrifice anything. So my hubby was one, for example, where his boss just wouldn't do salary sacrifice super. So we were stuck with just the 9.5% going into his account. But since these rules changed a couple of years ago, I'm able to get to the end of the financial year, see what the boss has put in, and then just make an extra contribution into the fund for him out of our savings, and then he claims a tax deduction for that in his tax return. So these personal concessional contributions mean that you are getting a tax deduction for those contributions. It does get taxed 15% when it goes into the super fund, but the super fund sends that off just like they would do with those employer contributions, but then you get to claim it in your personal tax return. There are age limits and work test limits if you're over 65. So I've got a table coming up to show you that in a little bit more detail. And because we're still talking concessional contributions, the same as the employer ones, concessional just means that somebody's got a tax deduction for it. So whether it was the employer claiming a deduction for what they've put in, or you putting claiming a tax deduction for what you've put in, that makes them concessional contributions. That maximum is $25,000 per person per year. So if you are a self-employed person, well, that's fine, put your 25 grand in. But if you have perhaps well, you're either an employee or maybe you've got a job on the side or something, just make sure that between you and the boss, you only go up to the 25,000, because otherwise it's not tax effective, because you'll get one of those excess contribution notices. One of the rules that they introduced a few years ago was that if you're not able to use up your full $25,000 contribution limit each year, you can actually carry forward those unused amounts for a period of 5 years and make catch-up payments in future. This can be particularly handy. So for example, maybe you've had to take some time off work, whether that's maternity, paternity leave, or heaven forbid, maybe you got sick for a year or something like that, and you weren't able to work and therefore didn't have any contributions going in. Well, the following year or the year after, when you do have some spare cash, you can catch up and make those extra contributions. So I've got some information on that coming up too in more detail. And again, just like we said before, just watch out. If you've got your insurance policies going through a super fund, just remember that those payments to that super fund also count towards the $25,000 limit. Here's the work test information for you. So as long as you're under 65, you can make personal contributions to your super fund, even if you're not working. So you might have an inheritance, or you might sell a rental property or a parcel of shares or something and win Tats Lotto, have some cash. Even if you have retired, as long as you're under 65, you can make that extra contribution into your fund. Or maybe your spouse is still working, for example. So if you've got spare money from them, you can pop that into your super fund. But if you're over 65, you can only make those personal contributions if you're under 75 and you've been gainfully employed for at least 40 hours over the 30 consecutive days during a financial year. There is talk of that work test age limit being increased to 67 to get it in line with the age pension start date. So we'll see if that comes through in the next year or two. But for the moment, it's if you're under 65, or sorry, once you hit 65 and over, then you've got to pass that work test. Here's a table that also summarises much clearer the contribution eligibility. So as I said, that 9.5% super that the boss has to put in, there's no maximum age and there's no work test. As long as you've earned more than $450, the boss has to put in 9.5% up to that maximum of 20 odd grand, unless your contract specifies more. Any voluntary employer contributions or salary sacrifice stuff, then there is that age limit where you have to be under 75 to be allowed to have those contributions made on your behalf, and you have to have passed, or if so, in other words, if you're between 65 and 65 and 75, you have to have passed that work test. Julia is going to be talking to you about the non-concessional contributions, and then I'll come back later on to talk about the capital gains tax contributions. But they've also got this age test and work test in them. The spouse contributions that we'll also be talking about a little bit later on, those can only be made for spouses who are under 70, but there's the work test and a couple of other tests for those as well. But that's a nice, neat little summary for you. Talking in more detail about those carry forward rules for unused concessional contributions. This legislation only started from 1 July 2018, which means it's your 18-19 contribution cap. So if you haven't used your 18-19 $25,000 cap, then whatever you haven't used in this current 18-19 financial year, you will be able to access next year in the 19-20 financial year. And therefore, so for example, if you only put in 20 this year, so you've got 5 spare, then next year you'll be able to put in 30, being the normal 25 grand plus the 5 grand that you didn't use up this current financial year. But what you have to watch out for is that you can only make those carry forward contributions if your total super balance at the end of 30th of June the previous financial year is $500,000. Now, from a practical point of view, that just means that you're going to have to hang on a minute at the end of the financial year, wait until you get your annual statement from your super fund to confirm exactly what your 30th of June balance was, to know whether you're over or under the 500K, if you're close, obviously. So, you know, don't go putting it in on the 1st of July until you've made sure that your 30th of June balance was definitely under the 500K. There was talk of the Labor Party cancelling those catch-up provisions, but at this stage, given that they didn't win the election, that strategy looks safe for the moment. So on that basis, I'm going to hand over to Julia to talk to you about the personal contributions being the non-concessional ones. Over to you, Julia.
Thanks, Melissa, and hi everyone who's watching today. I'm just going to step back a little bit and just carry on when Melissa explained what concessional contributions are. I just wanted to explain probably in the easiest way that I've ever understood what non-concessional means is it's just simply contributions that have been made with after-tax dollars, i.e. you've already paid tax on this money. So once you have the money after tax, you can put that into super. And when it goes into super, because you've already paid tax, you won't pay any more tax on it. And when it comes out of super, you won't pay tax on it. So you've received no concession, and that's why they're called these non-concessional contributions. And once they're in this super world, that tax treatment of them can mean something, but that's an entirely different topic. But so I'm talking about contributions that you've already received the money in the hand after you've paid tax, and we're putting this into the super environment. So why are non-concessional super contributions important? Really, it's your way to really get decent amounts of money into super. So what Melissa was talking about, essentially it's $25,000 a year. So if you've only got $25,000 a year, you really do need to do something more to give you a decent sum of money in retirement so that you can actually live the lifestyle that you need to or want to. So it's the way of really, in the old days, you used to be able to pretty much just wait until close to retirement and then put in large sums of money. And even back 3 years ago, you could put in $540,000 in one hit. And it's really changed the landscape in the last few years. And it means that we really actively need to think about how we are going to build our super in this tax-effective environment to give us the lifestyle that we want. So the non-concessional contributions I'll talk about in the next few slides. I'll also talk about the total super balance cap. And this cap was introduced back in July 2017. And it's the $1.6 million that you hear about. There's two aspects to the $1.6 million. There's the total super balance cap, and then there's the pension cap. And they're similar but different. And the pension cap means that you can only have $1.6 million in pension. And the total super balance cap means that you can only get in now, going forward, we can only get $1.6 million into the super fund, and you can't contribute once you've got more than that unless it's through employer contributions, or there's a couple of other ones, and Melissa will talk about the downsizer and the super, putting in the capital gains tax contributions in if you sold a business. But other than that, it's largely $1.6 million, and there's the eligibility around doing that. So you need to actively be thinking about that prior to retirement. And then, so I'll talk about some of the other contributions as well. So I'll talk about the non-concessionals, and then I'll talk about spouse contributions and government co-contributions as well. So I'm just clicking through. Has that gone, Ange?
Give it another try now.
Okay. So total super balance cap. So, as I said just before, this cap was introduced from 1 July 2017, and it essentially caps how much you can contribute into the fund as a non-concessional contribution. So once you have a member balance of 1.6 million or more at the start of a financial year, you are no longer eligible to make non-concessional contributions. So this means that you must really consider what types of contributions are being made into your fund and when you may no longer be able to put money into the fund. And it's also really important, as Melissa talked through those concessional contributions, if you've accidentally gone over that $25,000 previously, you were able to just go, okay, well, we've gone over the $25,000, let's just allocate that excess into the non-concessional portion. And you can no longer do that if you've already maxed out your non-concessional allocation. So we've just got to be a little bit more mindful than we used to. And this happens often with just employer contributions, or as Melissa talked about before with the insurance premiums, as people get into their 50s and 60s, they're often keeping life insurance policies for estate planning purposes as much as anything, and these premiums can be quite substantial and often, you know, $25,000 or $30,000 for a large life insurance policy. And the way that members have been able to maintain this premium has been through making additional contributions to super. So it's really important to think about the overall plan. But there are still some tricks. So it's important to know that there are ways to get money into super and that it's not just 1.6 and you can do nothing. So Melissa will talk about that with the downsizer. So the non-concessional contribution, the main strategy here about is the bring forward rule. And it's still not clicking, Angela. Here it is, bring forward rule. So the bring forward rule is a strategy that gets thrown around quite a lot, and on the surface it really is quite a simple strategy. You can bring forward 3 years worth of non-concessional contributions. So at the moment the non-concessional contribution cap is $100,000 a year. So if you bring forward 3 rules, you can essentially make a non-concessional contribution of $300,000 in year 1. And then you're not eligible to make that contribution again in year 2 and 3, but year 4 you can make a contribution again. So on the surface it's very simple, but what we need to consider now is what your super balance actually is, and to be mindful of that before you bring the bring forward rule into play. So that's why we ask those questions at the start. What is your super balance? Because if you're between 1.4 and 1.6 million, it can be quite tricky to work out how much you are actually eligible to contribute. So if you're less than $1.4 million and you're under age 65, by all means, if you haven't used the bring forward rule previously and you've been making non-concessional contributions of $60,000 or $70,000 each year, then you can put in that $300,000. If in a year, so this financial year, you put in $120,000, that means that you've triggered the bring forward rule, and over that next 3 years that we're in, you've only got that $180,000 left to contribute. So it doesn't matter how you make up that $300,000, it just means you can only contribute $300,000 in 1 year, and as soon as you go over $100,000, you're triggering that you're using the bring forward. So especially important, go back and look at the slides once they're with you. You need to be mindful of how much you contribute once you're at that 1.4 to 1.6 million. And it's always important to remember that whilst we have these rules about your age and your ability to contribute, you can actually use that bring forward rule at any time in the financial year that you are age 65. So if you turn age 65 in January, you still got till 30th of June to use that bring forward. And it's really important because that might be your last opportunity if you no longer work to do so. So other contributions, so that's non-concessional contributions. And in summary, non-concessional means you're making contributions with after-tax money and you're making those larger contributions, and those contributions don't have any tax deductions available with them. So other contributions that I'll talk through today are the government co-contributions, the spouse contributions, and using spouse super splitting. This strategy really didn't have as much importance before we had that $1.6 million cap, but it really is quite important now to consider yourselves as a combined unit and making sure we get the most into super between you. And then I'll go through, then Melissa will work through the downsizer and the first home owners super saver and the small business capital gains tax contributions. And then Angela will wrap it up and will answer any questions. So government co-contribution, it literally is the easiest way to make a 50% return on your investment, and people forget about it. So it basically is a bonus super contribution from the government for the low-income earners. So it was recognised that it can be really hard for low-income earners to save for retirement. So to make it easier, the government introduced 2 types of bonus super contributions to help grow super. So the first one is the low income super tax offset, and this helps those earning less than $37,000 a year. So in this instance, you don't actually even have to make any extra super contributions. All that happens is the government recognises that if you earn less than $37,000 a year and you're eligible, they'll make an extra super contribution to your fund, and this is going to be equal to 15% of your concessional contributions up to $500. In essence, what they're saying is that if you're a low income earner and you earn less than $37,000, they'll pay back the tax that you've incurred on that contribution. So if money goes into super in a concessional world, you put in $100, $15 of that will be taxed. So in your fund, you only actually get $85. So the government, if you earn less than $37,000, will repay you the $500. So that's the first type, and that's the low income super tax offset. The second type is the government co-contribution, and this is the one where you actually have to do something. So the government would do a co-contribution that helps people if they earn less than $52,697 a year, and that person makes an extra super contribution. So it's not a voluntary contribution. So how this works is that the government rewards you for making that personal non-concessional, so after-tax contribution. So if you, and it's tiered. So if you earn less than $37,697, the government will give you that maximum co-contribution, which is $500 based on and basically it's 50 cents from the government for every $1 that you contribute. So it doesn't matter if you do this in one go or if you do it as regular payments. It's simply the government will look at the total that you've made that year, and then they'll base their co-contribution on that total amount that you've put in as non-concessional contributions over the financial year. So as your income increases, the amount of co-contribution reduces. So it reduces up until a point where you earn $52,697. So basically, anywhere between $37,600 and $52,600, anywhere between there, you'll be eligible for some co-contribution from the government. So, and it's interesting because more and more, I'm a financial planner, more and more when we're discussing with clients their super contributions, we are also discussing with them helping their children start putting money into super. So we're seeing them, put in $500 at the end of the year for their children just to help boost super, and it's basically free money from the government helping them. So so if you put in $1,000 for your children, the ATO will give them $500 directly into their super fund after their tax return is lodged. Obviously, there's eligibility requirements for your children to be earning within those brackets. So the next type of contribution I'll talk through is the spouse contribution. And this is when you contribute to your spouse's super fund. It has to be an eligible super fund when their income is less than $40,000. So again, subject to eligibility. And in this instance, it includes your living status, your spouse's residency, their age or work test, and their super balance as well. So I'll put together an example for you. So my favourite, Harry and Meghan, the royals, their spouses. Harry earns maybe just $19,000 and Meghan makes a $3,500 contribution to Harry's fund. Harry and Meghan, they both meet the eligibility requirements, so Meghan can then claim a tax offset in her tax return for the contributions that she made to Harry's fund. So this tax offset is calculated at 18% of the lesser of, and this will be in the slides, but it's 18% of the lesser of either $3,000 minus the amount of minus any amount over $37,000, which is the threshold. So Harry, in this instance, earned only $19,000. he'll get the 18% of that, or the value of the spouse's contribution, so $3,500. So Megan is entitled to the tax offset of $540, and that tax offset is calculated as 18% of $3,000. So $3,000 is less than the spouse contribution of $3,500. So it's a really easy way to boost some tax deductions by thinking about putting money into your spouse's super. So you just need to meet those eligibility requirements, and also check that your spouse has a super fund that accepts spouse contributions. The other way that you can increase your partner's super is by splitting. So what's called spouse super splitting. And you can do this up to 85% of your before tax super contributions, and that you've either made in the financial year in which you received them or the previous financial year. So if we think back to Melissa's slides earlier, before tax super contributions can include employer and salary sacrifice contributions, as well as personal tax deductible contributions. So to be eligible for contribution splitting, your partner must be less than their preservation age or between their preservation age and age 65 and not retired. So the amounts that you split between yourself and your partner's super will be counted towards your concessional contributions cap. So you can't go more than $25,000 and put $25,000 in for them as well. So it's limited to that $25,000. It just means instead of it going into your super fund, it's going into their super fund. So again, you need to talk to the super funds and actually make sure that they offer this feature and what the fees are to do this. It's also mindful that if either of you exceed those super contribution limits, additional tax and penalties may apply, just like if you were going over the cap in your own fund. It's also mindful that you're putting your super into your spouse's super. From a financial planning point of view, it's important to remember that the value of money once it's in super can go up and down depending on what investment options they have. So you need to be looking at what's the overall strategy between you both and understand how you are comfortable with that money and what it's invested in and the time frames. It's also really important to remember that once it's in your spouse's super fund, you're then bound by your spouse's ability to access that money. So if you're a 50-year-old lady married to a 30-year-old spouse, you know, you might not be able to access that money again for another 25, 30 years, depending on when your spouse can actually access those money. So condition of release is really important to consider. And very broadly speaking, conditions of release are preservation age and retirement, or reaching age 65. Or there's a few other conditions of release such as financial hardship, incapacity, and a terminal medical condition. But generally speaking, we're talking preservation age or retirement or age 65. So if you're close to reaching your, accessing your money and you're putting money into your spouse's super, you might not be able to access it as quickly. But the reason you would do this is to even out your super balances. So that brings me to this rebalance strategy. And I won't spend too long on this, but I do feel it's really important to reiterate, just with the introduction of this $1.6 million super cap and this $1.6 million pension balance cap, which are slightly different, that you really want to consider yourselves as a partnership and see how much money is in each person's super. And I had a client in a couple of weeks ago, and the husband, he had $1.8 million in super, and of that 1.8, he had 1.6 million in pension, and he had $200,000 in accumulation. Meanwhile, his spouse had only $800,000 in super. So there's $200,000 of super that really could go across to the spouse and boost up and be 100% in pension between the two of them. So we worked through strategies to do that, and we had the ability, due to working and being between 60 and 65, to pull money out and recontribute it. So you need to be talking to advisors about how you can do that, because the last thing you want is to have someone with a high balance and not all of their money in this tax-free pension world, and you've got the other spouse with money sitting in pension but with a really low balance in comparison. So, and of course, there's other considerations to be made when talking super splitting, especially when we start talking blended families and estate planning considerations. But generally speaking, collectively as a couple, you really should be trying to make sure that you're both with as much pension as possible and not paying tax if you don't need to between the two of you. And that's just one example I had a couple of weeks ago, but that's pretty much me, just these non-concessional contributions. Remember, the $100,000 a year, you can bring forward the $300,000, and then using these other strategies of looking what's available with the government and the co-contributions, and looking what you can do with yourself and your partner collectively. And I'll hand you back to Melissa.
Thanks very much, Julia. That's great. So yeah, if you've got spare cash lying around, you know, if you've got that in a bank account, you're going to be earning interest on that and paying tax on it at your top marginal tax rate. If you chuck it in your super fund as a non-concessional contribution, it'll only be taxed at sort of 15% while it's in accumulation phase, and when you retire and go into pension phase, it'll all be tax-free. So it's a much more tax-effective environment for you to be saving your money for retirement. And as Julia pointed out, if you're a low income earner, you might be eligible for that $500 co-contribution, and or if you've got spare money lying around and your spouse's balance is a bit low, then maybe making that spouse contribution into their account and getting a bit of a tax offset. You know, again, an 18% rate of return's pretty darn good. So that's definitely something to consider. Some other ways that you can get money into your super fund is looking at the downsizing. Doing it the other way around. All right, we'll do first home super saver account first. This one allows first home buyers to save up their home deposit within their super fund. So the idea is, especially maybe for the younger people listening, or if you've got kids who are you know, perhaps in their 20s and looking to save up for their first home, again, the whole idea is that they can save their after-tax money, pop it in a bank account, earn interest on it, fantastic, except that the interest is going to be taxed at, you know, perhaps 34% or something. The idea here is that if they salary sacrifice that money into their super fund, they'll only be paying 15% tax on it going into the super fund. And what they can do is therefore save up much more tax effectively in that fund, because of course the super fund earnings will only be taxed at 15%, whereas interest in their own name would be taxable at perhaps 34%. But the idea then is when they do find their first home, they can do a withdrawal of those eligible contributions, and it can be salary sacrifice ones, or it can be personal contributions, just not the compulsory 9.5%. That's got to stay in the fund. But they can pull all of that money out, up to $30,000 in total, and use that as their deposit on their home loan. So it's just a much more tax effective way of saving for their first home deposit, if you like. There are some rules for being eligible to make that withdrawal out of the super fund. So for example, they must not have owned property in Australia before. They have to be at least 18 years old making the withdrawal, not have withdrawn money at the past, so there's only one bite at the cherry for this. The non-concessional contributions that you put in out of your after-tax money can be withdrawn anytime tax-free, because it was already taxed before you put the money into the fund. Any concessional contributions and the earnings do get taxed at that marginal tax rate, but with a tax offset of 30%. So, and you have to watch out, because you've got to be careful. you've got to enter into a contract to buy or build your first home within 12 months of making the withdrawal. So just be careful with your timing. That's usually just an issue. Logic says you shouldn't take the money out before you know you have to pay your deposit, but sometimes if you're going to go to an auction and you don't know whether you're going to win the auction or not, you know, you're effectively taking the money out beforehand. So just be careful on that one. But as Julia mentioned too, you might even have kids who are working or whatever, making contributions for them, for example, so that they get that government co-contribution. As long as they're over 18 when they make the withdrawal, it can be quite handy. So just a really effective way of getting some extra money into super, which will either be for their benefit in the long term or gives them an opportunity to withdraw it for this first home buyer deposit. Let's have a look. No, I did miss it. Hang on. The downsizing of the family home. This one, sorry, the clicker's a bit sensitive today. It doesn't want to play. Thank you, that'll do. Whoa. It's got a mind of its own today. Downsizing the family home. This one is available as a really effective way of getting some last minute money into superannuation, and a big contribution too. Normally we had those 65-year age caps where after 65 you had to meet the work test, and once you got to 75, you know, even that didn't work anymore. So here there's no age limit on making a downsizer contribution, but the requirements are you have to have owned your home for more than 10 years, and on that basis you're able to contribute up to $300,000 per person, so that's $600,000 for example between a couple, into your super fund tax-free. And that's on top of any other voluntary contributions that you might be able to make. So, you know, maybe you're 60, you've retired, you still do your 25 grand concessional contribution. Maybe you've got some other, like your leave payout money and that kind of stuff. You can put that into your super fund as a non-concessional contribution, and then you downsize your house and you put $300,000 each into your super fund. So that all works really well. The total super balance, there's no cap on that either. So we don't care if you've got a couple of $1 million each in your super fund, you're still allowed to use this downsizer family home contribution. So yeah, bear that one in mind. Just have to make sure you've owned your home for more than 10 years. It doesn't matter whether it's your house or your spouse's house. So, you know, particularly with a lot of blended families, you find one person moving in with the other, but technically there's only one person's name on the title deed. That doesn't matter, just as long as one of you has owned that home for more than 10 years. There's also an opportunity that, you know, maybe you are moving from a $1 million house to a $500,000 house or something. Even though I'm trying to say, it doesn't matter, it doesn't have to be the sale or the net price difference. In theory, you could even upgrade. If you have a $1 million house that's, you know, too big and you want to supposedly downsize to, say, a townhouse, but it's a brand new townhouse in a very fancy location and it actually costs more than your original house, that doesn't matter. As long as you've got other money to pay for the new place, you can actually still use your sale proceeds from the old house and put that into super, even though technically, I mean, you're downsizing in size, but you're certainly not downsizing in price of house. So there are a couple of tricks to bear in mind with that one. So that covers the two housing ones. What we're now going to look at is the small business CGT concessions, if the slides decide to play ball. Thank you very much. So these ones, if any of you are small business people, there is very generous capital gains tax concessions available to you to potentially eliminate any capital gains tax liability on the profit that you make on sale of your business. However, there are very strict eligibility criteria. So you have to talk to your accountant before you go down this track to make sure that you are genuinely eligible. To be a small business, the first criteria is that you have to have turnover less than $2 million or net assets of less than $6 million. Now, that sounds easy at face value, but just be careful if you've got, if you own part of a business, then we've just got to be a little bit careful about how much you own. So, for example, the minimum percentage ownership interest is a requirement. It's you know, sometimes it's 20%, sometimes it's 40%, depends. Different rules apply to partnerships, companies and trusts, things like that. But the main thing is that the asset that you are selling is used in a business. That's what's called the active assets test. So you have to be a small business. The asset that you're selling has to be actively used in the business for it to be eligible for these concessions, and you have to pass those minimum percentage test. If you do pass all of those tests, then you've got a couple of different options. If you've owned your business for more than 15 years and you are retired, and you're retiring, then if you're over 55, the money's tax free. If you're under 55, you can put the money into super tax free. But just note that there's a limit on how much you can put in using these requirements. If you're not retired, is it more than 15 years owning the business and retired, you can still use a retirement exemption. If you're over 55, that money's tax free. If you're under 55, you can put that money, that capital gain, into superannuation tax free. But in that case, you've only got a maximum limit of $500,000 per person. But for example, if it's you and your spouse in your business, well, there's $1 million between the two of you. But so, you know, running a small business and making a profit on the sale of that, A, is very handy, but B, you can just about eliminate all of the tax on it by using these small business concessions. But as I keep saying, it's really, really complicated. There's lots of fine print that you've got to be really careful that you tick all the boxes on and do all the forms and pay the money into super at the right time and all that kind of stuff to make sure that it does stay tax free. So be careful and talk to your accountant first. So I think we'll wrap it up there. I'd just like to remind you that what we've been talking about are the legal and tax facts. This is what you could possibly do, not what you should necessarily, what you should be doing. So these are not personal recommendations. What you have to be aware of is that superannuation is a long-term investment. There are these annual limits and certain eligibility criteria. So, you know, again, talk to your accountant or financial planner to be absolutely positive that you have met the requirements, for example, for your tax deduction, let alone to actually put the money into the super fund in the first place, because there are extra tax penalties and interest if you do go over those thresholds and get an excess contributions notice. And of course, with superannuation, we've got those restrictions about when you can access your superannuation, those things called preservation age and the fact that you've got to be retired and stuff like that. So even though, for example, you could put 25 grand into your super fund and potentially claim a tax deduction for it, you need to stop and think, actually, given my personal circumstances, is that actually a good idea? Because I'm not going to be able to access that money again until future, when you do meet those requirements and can pull the money out of the super fund. Now, there could be all sorts of reasons, I mean, why that could be a good idea, as well as why it could be a bad idea. If you've got other commitments, maybe you need to keep a little bit of emergency money outside of superannuation. But if your goals are to build up your superannuation for your retirement, then, you know, yes, go for it. But just be careful and talk to your financial planner or your accountant about those kinds of issues. So just finishing off, check out your eligibility for making contributions into the fund to make sure you don't breach any of the rules and get the money sent back to you. Watch your transfer balance cap. As we pointed out, the poll was all about the $1.4 million, because that's where the bring forward rules of the 300,000 start to get reduced, and or you can't put money into super anymore. So just be really careful to watch that. And again, talk to your accountant, because the timing of when you make certain contributions affects that transfer balance cap, and some things count towards it and some things don't. So watch that. Also, as part of your annual review, just have a think about who the beneficiaries of your super fund would be if something happened to you. You know, the primary goal of superannuation is for your retirement, but you know, unfortunately, sooner or later things happen, and so who's going to get your superannuation account balance, and perhaps is it going to be in the form of a lump sum or a pension? And as I mentioned at the beginning, just make sure that your super funds has a good investment strategy to make sure that your super is working as hard for you as you worked to earn it in the first place. So talk to your licensed financial advisor or accountant about what's best for you. So on that note, are there any questions?
We've actually got one question that popped up from Harry, which I'm just grabbing now. Oh,
okay.
Hang on, it's just disappeared. Okay. Generally, what is the earning rate per annum if I contribute cash, for example, NCC amount of $100?
Okay, so
do you want me to take that one?
Oh, sure, I don't mind.
Oh, so from a financial planning perspective, because Melissa's an accountant and I'm a financial planner, you know, it really depends where you're putting that money. So if you go into cash, it will go into cash. If you're in an industry fund, in a balanced investment or a default My Super investment, I mean, you need to go and look at your super fund's investment history, but I mean, you'll hear all the disclaimers. Past performance is not an indicator of future performance, but you should be making your money work for you. So you should have a diversified investment strategy. This includes cash and term deposits and fixed interest secure, and then your growth strategy. So depending on that asset mix, it really will depend on how you're invested. So that could be anything. And sorry, Melissa, I interrupted you.
Oh, yeah, well, I was just going to say the same thing in terms of if you're putting money into super, into a cash superannuation account, well, it's going to earn roughly the same amount of interest as if you put it in a bank account that wasn't in a super fund, you know, because cash accounts pay the same interest rate regardless. As Julia pointed out, the question would be, you know, why do you only want it in cash? That's only ever going to earn 1 or 2%, barely keep up with inflation, if that. You know, what you should be trying to do is put your money into, like she said, a balanced super fund, or maybe even something higher depending on your risk profile, where the super fund pools your money and puts some into Australian shares, some into international shares, some into property, and then your rate of return might be a bit higher. As Julia's the expert on rates of return, but you know, normally, I don't know, property types investments might get you 5 or 6% or something, and shares might get you 7 or 8%, that kind of thing, which is better than cash. But the trick is to be diversified, have a little bit of everything.
Thank you, and hopefully, Harry, that has been helpful. We also have a question from Daryl, who said, how do you go about finding a superior super fund? Who can make an independent recommendation, because I'm having trouble finding an alternative?
Good question.
Do you want me to answer that one too, Melissa? Or start?
Yep. Yep.
So when I look at, as a financial planner, when I look at super funds, I first of all look at how much your balance is. So very, very generally speaking, because again, Melissa has said everyone's situation is different. Generally speaking, if your balance is less than $150,000, you really should be going for a fund that has low admin fees. So Australian Super has an admin fee of $72, and industry funds in general have admin fees between $72 and $300. how they make their money is on the actual underlying investment. So a balanced fund, and that will have what's called an investment cost with it. So that investment cost can range anywhere between 0.3% up to 2%, very generally speaking. So if your super balance is less than $150,000, you know what, you go for something that has a low admin fee, a good amount of investment options, and that those investment options have generally provided a good ongoing return, somewhere between 6 and 10%. Once you get over that threshold of about $150,000, you really need to look at what investment options are available to you and what those investment options cost, because it becomes a fee on your funds under management, as opposed the admin fee becomes inconsequential, and that fund under management fee really is the driver. And then you need to consider, will this super fund carry me all the way through to retirement? So I've got a client we're in the middle of rolling over a first state super to a retail fund, and that first state super, fine building up the accumulation balance, but once you want to go from accumulation to pension, they'll charge you capital gains tax to sell down the investment and then buy the pension option. So you do, once you get to that $200,000, really need to consider the features, structure, and options within the fund. So use a retail fund up to $150,000, grow it, and then really go and talk to someone about it. And some websites that can help, Chant, West, and CanStar will give you some general features advice as well. But a planner really will look at that overall cost for you and performance.
Excellent.
Well said. Yep.
Thank you. There's another question from Dale. Isn't there a regulatory body which assesses all funds' performance of funds, and have they created a good performers list?
Chant West.
No.
Look at your apples. Yeah, Chant West website.
Sorry, what was
comparison.
What was the website? And I'll put it in the notes.
Chant West, CHANT West. So they give apple scores for different super funds.
Okay, great.
Really, that's very, very generally speaking. You really do need to look at your own balance and see what it is. The Chant West gives pretty good industry sectional analysis, I guess.
Okay, great. We'll put that into when the recording and the slides come out to everybody. We'll just pop that in there as well, but understanding very much that you need to get the personal advice. Sorry.
Can I just add to that? From my point of view, just reiterating, superannuation is just the vehicle, like a company. A company can do anything. So a superannuation is the same thing. It can do anything. So the question is, who's running it, and making the decisions, and what are they investing in? So track record, as we said, isn't always a good indicator of what's going to happen going forward, but it's trying to find a super fund that has good value rate of return compared to the fees. We talk to clients about the difference between actively managed things versus passively managed. So if a super fund's being passively managed, they're just sort of following the market and they're not trading, every 5 minutes, but consequently the fees are low and it puddles along nicely. There's also more actively managed super funds out there where the managers are working very hard, chasing down every bargain to earn a lot of money, but that takes time and energy, and therefore the fees are quite high. So the trick is working out your personal risk profile. And are you happy with the slow and steady approach, or are you trying to chase down every dollar? And are you prepared to pay for the fees for that, even though the rate of return isn't necessarily guaranteed, but might be worth it? So lots of things to talk about. So yeah, the idea is to go and find an independent financial planner that you can talk to about what would suit you best.
Thank you. Okay, I'm just checking through to see if there's any other questions. We've still got quite a few people on the line. Now's the good opportunity. If you've got something in the back of your head you'd like to bring forward for the girls to address, you can just pop it into the chat box and we'll take care of it. Okay. Okay, well, that seems to be all our questions for now. But as I was mentioning before, we will send the slides and we will send that link as well that Julia mentioned so that you can go back and listen to the recording and go through the different information and what was most relevant for you. Now, we're just bringing you back to the point, which is that this was a part of DFKANZ. This was who the webinar, the masterclass, was hosted by. There is our website just in front of you, dfkanz.com, and the phone number. So thanking you for your time, thanking Julia and Melissa for providing so much insight that we hope has lifted up your knowledge today as well. Please feel free to get in touch with us to respond to the email or to the details in front of you if you would like to book a session with one of our financial planners who can assist you. And to also let you know that this was one in our Better Business series, and that there are more masterclasses coming up. The next one is on the 25th of July, where we'll be talking about hiring, firing, and everything in between. So you'll receive an invitation to come along to that webinar and the remaining ones that are in the Better Business series. As you leave this webinar, you'll see that there is a request for some feedback on the content and the experience you had today. That will be really useful for us. It just takes a couple of minutes so that we can make sure we provide value and relevant content in all the information that we provide going forward. So again, thank you so much for your time today, and we look forward to seeing you on a masterclass again very soon. Take care.